Is it basically the bond market that is driving the equity market at this point?
Hi, Kelly. Thank you for having me. Indeed, we think that tighter monetary policy and higher bond yields are going to be one of the biggest themes driving the markets this year. And if you were to choose one indicator that you could have a foresight on to know what the market is going to do on the day, I would pick the bond yield, and especially the direction of the real yields, which we think is going to be key in terms of determining the leadership between value versus growth in the market.
Value versus growth, and which do you think is going to take over this year? I mean, it seems like every year for the past few, people have forecast the return of value or that rotation, and it hasn't really panned out.
That's a fair point, Matt. So the way I look at it, as I look at the forecast that our rate strategists are giving me on the real yields, and in the US, we think that real yields from around negative 70 basis points now are going to move to negative 25 basis points. So still quite some way to go. And we estimate that this could drive another 10% outperformance of value over growth in Europe. We've already seen around 10% of that happening. So in the near term, as long as bond yields are going to move higher, we think that value has more to gain.
What do you think about, it does also seem, Beata, like every year strategists say, Europe is the place to be now. This is Europe's year because it's so undervalued compared to the US. Now, there may be some structural reasons for that, but we're hearing the chorus getting louder on that point this year. How do you look at European equities versus the US markets?
So being a European equity strategist, I'm pleased to see this move in bonds moving higher, because we think if there is one indicator that could make Europe outperform the US, it's going to be higher yields, and especially higher real yields. So, and the reason for it is structural in terms of how the market is built, right? So, basically, higher real yields are a big headwind for the valuations of the very expensive parts of the market. So, growth, tech. We estimate that in Europe, the valuations of luxury goods or tech, these really highest rated sectors, could derate by on average 5 PE points if real yields reach this negative 25 basis points, as I've mentioned, we have penciled in our forecast. So we think the US has more to lose in this move higher on the real yields than Europe. Of course, Europe has some parts of some expensive parts. However, it still has more value bits that will do better and make Europe outperform. And one thing I really would like to mention in Europe, a standout to benefit from the higher real yields, is the UK, which is our favorite way of playing the value rotation.